John, you just reported one of the best quarters in Blackstone's history, despite all of the whipsaws in markets. What are the biggest drivers of performance that will last you into this year?
Well, thanks, Sonali. Great to be with you as always. It was a terrific quarter for us. Distributable earnings up 56%. The key drivers were the things that really are essential to our business, which is fundraising, investing, realizations, all at the highest level in 2.5 years. But I think the bigger picture stepping back is what's quite exciting. We're seeing a real sea change in terms of openness towards alternatives, towards private assets. And you see that in the individual investor space, what we call private wealth. We had an 80% increase in inflows last year in this area. And January just now was the best month since May of 2022. Investors really appreciate the premium returns there. And then I would say private credit with insurance companies, with pension funds, with individual investors, the ability to bring up those investors right up to the borrowers, capture some additional yield, that's really paying off. And if you look at our corporate real estate credit assets together, they've grown from $176 billion 4 years ago to $450 billion today. We do that as a pure investment manager, and we just continue to see a lot of momentum. So a great quarter, but it's really this sea change that excites me in the outlook as we go forward from here.
We'll talk more about the sea change that you're seeing, but I do want to go right to one specific business, the data center business, because Blackstone is one of the biggest owners of data centers across the country. Of course, the claim by China's DeepSeek that they could now do this much more efficiently in terms of capital expenditures. Investors are now very concerned about the infrastructure that's needed to fuel the AI boom. Did you call up your clients after the weekend to see whether they might be spending less, and how might this be impacting you in the longer term?
We absolutely spoke to those clients because they're essential in the business. And I would just describe sort of where we sit in data centers. We are the largest investor. We've got $80 billion of leased data centers around the globe. The good news is they are long-term leased to major companies, and we don't build these centers speculatively. So it's a very prudent approach. The question, though, coming out of DeepSeek is what does it mean for demand going forward? And I just start by saying what we've seen from other, people talking about this, which is the price of compute is coming down and the usage is obviously going to go up. And when that happens, we still think there's going to be a vital need for infrastructure. Microsoft and Meta on their calls yesterday talked about fungibility. They said we still need physical infrastructure. In fact, Mark Zuckerberg said he thought it was a strategic advantage, but they said maybe there's less in training, there's more in inference, maybe there could be more in cloud. So I think as we see more and more adoption of AI, there's going to be more and more demand for compute power. It will happen in data centers. The form of it may change a bit, but we still think it's essential, as is the energy and power, which we think will continue to be needed. So we're going to continue to operate in a very disciplined way. We're going to build when we have demand from our tenants. It feels like it will continue. The form of it may shift a bit.
How might you see this impacting others? Because the reality is you have a lot of Wall Street that followed you into this trade, many other private investors looking to help build data centers. Do you think that there are mistakes being made?
Well, so far, I would say not, because we haven't seen speculative building, right? You don't go out and build $1 billion data center if you don't have a tenant, you don't have power. It's not like building condos in Miami and you're sort of betting on an overall market. It's very specific. There's a relatively small number of major tenants, so we haven't seen an overbuilding. It may give folks some pause. There may be a little less capital flowing into the sector as people wait to see where this settles out. But from our perspective, we're going to continue to look at the demand signals from our tenants. And if they need this, we think we're uniquely positioned with QTS in the US and Europe and with Air Trunk in Asia. We think we're set up well to serve their needs at scale, to deliver them timely what they want. And so we're going to continue at it. We'll see what others decide.
You know, elsewhere in the world of real estate, you've made a big declaration now that the office sector has bottomed. And Bloomberg reported just this morning that Blackstone is in talks to buy a 50-story skyscraper in Manhattan. How assertive are you willing to be in the office sector now that you believe that it has been bottoming?
Well, I don't know how big of a statement we've made, but we have been, as you know, pretty hesitant around office, not just in the post-COVID period, but going back. Office, U.S. office used to be 60% of our portfolio back in '07. Today, it's about 1.5%. And that really reflected the growth in capital expenditures faster than rents. We de-emphasized office as a major theme. And obviously, coming out of COVID, as demand declined, we were pretty patient there. I think now what we've seen is companies are starting to go back to the office. We've seen a complete stoppage of new building. And in some cases, we're seeing real growth, particularly in financial services. So if you look in Park Avenue in New York, we've seen vacancy decline from 15% to 7%. And I think we're going to start to see rents moving up and values, I would say, for pretty good quality office buildings around the country have fallen 50, in some cases, as much as 70%. So we do see some opportunity, but we're going to be selective. We want to focus on better quality buildings and better markets. But like anything, sometimes opportunity emerges. And when you see that moment, you do want to try to take advantage of that.
Now, I want to talk about deal making more largely and monetizations in particular, because it feels like that's still a place that's been relatively slow for Blackstone. It's been very slow across the industry at large. When does that come back, the selling of assets, particularly through the IPO market?
Well, if you were sort of making an M&A soup and you were looking for the ingredients, I think you'd feel pretty good in terms of your shelves being stocked here. So you'd say, I really would like a strong U.S. economy. Okay, check. We've got good numbers there. You'd say, I want a healthy equity market. The S&P's up 60% the last 2 years. I'd like to see a good IPO market. Well, the pipeline of IPOs is up double over last year. You can feel it starting to open up. Check. You'd say, I want strong debt capital markets. Well, investment grade spreads and high yield spreads are at amongst the lowest levels in history. Check. Rates are a little high, but still overall cost of debt capital is pretty good. I'd like a regulatory environment that allows M&A to happen, strategics to buy. We definitely have that. So I'd put a check there. And then I'd love to be after a period when there's been a lot of pent up demand for M&A, but because of dislocation, people haven't been able to sell. And we've seen that with private firms, public firms. And so there's a lot of desire for transaction activity. So check. So I think we have all the ingredients here. I do think we're going to see a better year for M&A in 2025. I think it'll strengthen as we move through the year. But for us, that's a very positive sign.
You know, part of the slowness in monetization does impact pay for deal makers. Are you concerned at all that your real estate investors in particular haven't been able to clip carry for 2 years in a row?
So I think our folks understand the long-term nature of the business they're in, that you're planting seeds for the future, that sometimes it's a more difficult environment. You're not harvesting gains. You need to be more patient until the environment improves, and you've got to stay at this. And of course, we've been through other cycles before in the early 90s or early 2000s, certainly after the GFC. Particularly for senior people, they understand there's a cyclical nature to this business, real estate in particular. So you need a little bit of patience. At the same time, when it comes to our employees, many of them, most of them are getting stock in our company. That's obviously done well for them. They believe in the firm and they understand the cyclical nature of the business. And I think they have a lot of confidence. So I feel really good about our team.
I also want to go here to what's probably the biggest question for investors right now, and that is uncertainty under policies under the second Trump administration. When you think about tariffs and the potential for more aggressive tariff policies, how do you expect your businesses to be impacted? And are you preparing those businesses for a policy that could be much more aggressive?
Well, I'll start with the fact that we do not have a lot of companies at Blackstone that export physical assets into the United States at scale. So that's very helpful. But we do have some businesses that are impacted. And what we're saying to them is we just have to wait and watch a bit here what's going to happen, because it's still unclear which countries, which industries, and how high the tariffs are going to be. There will certainly be more tariffs, but there is, as you know, a bit of tariff diplomacy that's going on. So we saw this in Colombia last week, where there's threats of tariffs, country changes their actions, those tariffs don't happen. I think there's going to be a lot of negotiating. So I think there's definitely going to be higher tariffs, but I think it's going to be fluid given some of these negotiations. So I do think our businesses need to be aware of this, our investors do, but I think we've got to wait and watch a bit to see where it settles.
Do you have concerns also on the immigration front that some of the immigration policies under the Trump administration could cause labor market distortions that could impact your businesses? Could it be inflationary?
You know, I think it's still early here to see what's going to happen. Obviously, there's a shift in immigration policy. The focus now is on deporting criminals. I think, again, we're going to have to wait and see the extent of what's going to happen to really understand it. On the inflation question more broadly, I was encouraged to see the new Treasury Secretary, his testimony when in Washington, D.C., he talked about the fact that inflation is a killer for working families. He talked about being committed to fighting the affordability crisis. So there's clearly a recognition that inflation is an issue. So I think they were going to take that into account across all their actions.
Do you worry that these higher interest rates, speaking of inflationary pressures, the market is pricing in less interest rate cuts, less than 2 at the current moment of speaking to you? Would that throw a wrench in some of the animal spirits that are starting to brew within these markets?
Well, I think a lot of that has been priced in. Certainly, rates not going down as much can slow things a bit. And I think the year started a bit slowly because of the rate volatility at the end of the year, maybe also a bit from the election. But I think if there's a settling of rates, if there's a general sense that inflation is coming down, even if it's at a slower pace than maybe people had hoped for, although our data in that area is pretty good, that if rates sort of settle in, long rates settle in, market participants will move around that. And I think as long as there's that level of stability, I think transaction activity can continue to be strong.
Final one for you, because your investment activity has been strong. It's been at the highest levels in 2.5 years. What are the biggest areas for investment for you this year to put big money to work?
You know, I'd continue to say that digital infrastructure and power, just given these major trends driven by AI and digitalization overall, electrification, we continue to focus there. Life sciences is an area we really like. Technology is going to change that business in a powerful way. And we express this in all different ways in terms of companies that run trials, phase 3 drugs, real estate for life sciences. Geographically, India is a place we've really leaned into, and we've got a lot of enthusiasm in terms of what's happening on the ground. Japan is opening up to foreign capital. We just did the biggest foreign investment in real estate in Japan late last year. I'd say the turn in commercial real estate, the cyclical recovery is something we're excited about. And then this overall move in private credit. We're going to continue to see investors move into that space, not only non-investment grade, but investment grade credit. And there's a lot of runway there. So I think there are a lot of interesting places to invest. Markets generally are in balance. We're not seeing excesses. So I think you'll see us being pretty busy at Blackstone, Sonali.